Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is June 22nd, 2023, and we're going to ask the question, is the Fed afraid of destroying equities? We're watching the market and we can see higher highs, higher lows, higher highs, higher lows, pushing to new annual highs on the SPX just a few days ago, and a gap down close up today, even as we tried to start the sell-off or continue the sell-off of those last 3 days, recovering to close up positive and erasing that gap down. So the market appears to be pushing things higher despite the fact that we're still dealing with inflation and despite that every other central bank is raising rates. Let's take a closer look. Today, specifically, the Bank of England raised rates and surprised us with not just 25 basis points, but 50 basis point rate hike. If we go back and look at all the rate hikes recently from the central banks, you'll notice as we go all the way back for multiple months. Let's look at the rate increases in May, April and May, and then we'll go into this most recent month and we'll focus on the Bank of England today. But Australia raised rates back in April. You can see we saw a raise in New Zealand going from 4.75 to 5.25, a surprise extra 25 basis points, so a total of 50 basis points or 0.5%. As we look down, Canada raised rates in the last month, but not this previous one. Australia raised rates 3.6 to 3.85. There's another 25 basis point hike. And the US raised rates. Well, that was May. If we look into June, just the last few, what we end up seeing is a surprise 25 basis point hike in Australia, and comments from the Reserve Bank of Australia saying that if we don't get it under control now, if we don't fight inflation now, the cost in the future will be so much higher if we're fighting entrenched inflation than if we fight it now as it's growing. Canada raised rates. Expectations were no rate hike, and they raised rates. That's why they're in green. As we look down and look at some of the other rate hikes, well, the Australia rate hike was a surprise higher. Canada was a surprise higher. The U.S. doesn't raise rates, gives every indication that we're going to pause, and maybe even pausing it for the next meeting and the meeting after that, while Euro raises rates 25 basis points as expected. Way down here, here we are with the Bank of England. They are expected to raise 25 basis points. They raised 50 basis points. So why is it that on a global stage, when the U.S. is pausing, why is it that every other major bank outside of Japan, every other central bank of the major 8, why is it that every other central bank is raising rates, not just raising rates, but many of them surprising with larger rate hikes, except for the U.S.? Is it that the U.S. is afraid to crush equities? Equities are not the U.S. economy, and yet it appears that we're propping up equities, moving money and liquidity into the equity market rather than focusing on getting inflation in check or managing the economy. Now, there's a direct correlation between the S&P's performance and the Fed's net quantitative easing since the pandemic. And really, this is just money supply or liquidity that goes into the market. And specifically, when the Fed is adding liquidity in the market and their balance sheet is growing, and cash is getting into equities, there's a direct correlation into the market. So they seem to be afraid of not necessarily overplaying their hand to get inflation in check, but they're playing this balance sheet. If their balance sheet is growing and liquidity is reaching the equities, then equities are growing. They have become entrenched ever since the time they became involved with mortgage-backed securities and buying debt from companies. So the correlation, the debt correlated to the Fed as well as the S&P, you can see is a very direct correlation. This is just going back to 2020 during the correction of from the pandemic. We can see that drop. The Fed pumps money in there, peaks out, and when they started reducing their balance sheet, reducing the liquidity in the markets, equities pulled back. Well, what's going on now? We're making higher highs, higher lows, higher highs, higher lows as far as the Fed is concerned, and that's exactly what's going on in the S&P. So the idea that if we raise rates and we restrict the amount of liquidity in the market, if we slow that liquidity down, that is going to be directly correlated and directly tied to the S&P and not being focused on from the view of what is good or bad for the economy. It does appear that the Fed is afraid. The problem is if the liquidity is slowed down and the equities fall, that will be a double whammy, and they're afraid of that. It will hurt the economy, certainly, and the equity market, but it'll also hurt them as the Federal Reserve and probably individually. If we look at the central bank rates and make a comparison, the Bank of Japan has not raised rates in 25 years, but the U.S. had risen rates all the way up to this 5.25% level, right behind New Zealand. The pound just last month was in the fours, in the low fours. And so we're seeing Canada, Australia, the pound, all raising rates and catching up to the U.S. dollar. So the relative strength to the U.S. dollar as far as central banks and deposits go is weakening. That does not help them. Not only does the dollar lose its purchasing power, it loses its demand as a central bank currency if the others surpass it. So there will be less demand from deposits, less demands as a central bank reserve currency, and still the struggle that we have a pending recession. Analysts are showing that there's a likelihood of somewhere between 70 to 100% probability of recession without moving any further, and they're saying it's closer to 100% if they raise rates one more time. The problem is, if we don't raise rates, we're not stopping demand, and we're artificially pumping up the S&P without it benefiting the economy. Consumers do not have more purchasing power. We've already talked about in the previous weeks that the CPI and the average wage increase has been revised lower for the last 6 months. Now, one of the things I like to look at, and I commented on this in the main room today, is that Tesla accounts for about somewhere between 15 and 20% of consumer discretionary. I don't think that's a good representation of how consumers are spending money. If we look at how consumers are spending money, and I've gone back and taken a ratio of 7 to 4 so that we can get as close as we can to 0% difference or $0 difference between the two from a year ago, we can see 7 times consumer discretionary minus 4 times Tesla starts us out at 0. We had a pullback July, August, September last year. We had a massive rally. That is consumer spending. That means either Tesla was falling or consumer spending was going up. So if we're taking out Tesla as a component of this, we saw a great run up. We saw this lovely run up to 520. And since then, you can see that since April, we're making lower highs, lower lows, lower closes. We're seeing weakness in consumer spending if we remove Tesla out of the picture. And if we're focusing on this through here, we can look at that pullback as an indication that we are seeing less demand and less spending on things that we don't necessarily need. And if I take the time and throw Nike in here, isn't it interesting how tightly correlated or how similar those two charts look, comparing consumer discretionary stocks minus Tesla to Nike? And you'll see the same pullback July, August, September, the same rally October to the peak in January, the same correction April, May, and June in this bearish move. So Nike is a good representation of consumer discretionary versus something like Tesla. And so the correlation that we're seeing is that we are adjusting and adapting our spending habits to avoid spending things on things we do not need. We are still being impacted by the high inflation in areas outside of energy, because energy has remained relatively low, but we're still seeing that response and that reaction to consumer discretionary spending because our income has not gone up as fast as what the cost of inflation has. In fact, we can actually stack these just for fun, and we'll put in that same 7 times XLY minus 4 times Tesla and make a comparison between these two charts during the same time frames that we were just looking at in conjunction with the last year. We have to zoom this one over just so they line up time-wise, and there you go. Sideways drop, rally from the end of October. In fact, your low was on 9/21, your low here was on 10/3. And so this turned a little bit earlier, but up it goes. There's your peak. There's your pullback. There's your flat in April and May and the sell-off. There's your flat in April, May and the sell-off. And so Nike is a representation of consumer discretionary minus Tesla. With all that being said, if we take a look at the dollar's purchasing power and what's been happening with the dollar, if the dollar stabilizes at this support level that we're testing and toying with today, if we're down here at these lows, testing these lows, if the dollar is going to bounce and return back up to the near-term high of 104, 105, a stronger dollar means a weaker equity market. If the dollar is going to strengthen at these lows, if the Fed is going to try to get in line with the rest of the world by raising rates, fighting inflation, rather than being the one largest nation of consumers that is not willing to fight inflation. If they get in line to start raising rates again, we're talking about a stronger US dollar, a slowdown in the economy, a destruction of demand, and equities will likely reverse at 2 to 3 times the strength of the dollar. Equities will likely reverse the same way. Watching for Nike to break through its lows, watching for the dollar to bounce up. You can use both of those as correlated indicators to tell us where the demand has slowed and decreased. Consumer staples is a great one. We talked about that in the main room as far as an investment that would preserve capital. Not necessarily as an indication that we want to see the top of the economy if consumer discretionary or consumer staples climbs. Consumer staples climbing is not necessary in a market pullback. Consumer staples can fall, but fall slower. Again, it's a preservation of capital, not necessarily a growth sector during an economic pullback. Sometimes the defensive sectors are just that, defensive. But if the dollar bounces here, and let's get a measurement here quickly, we're holding at support. If we see the Fed respond to the rest of the world, we see a 2% return to retest short-term resistance, possibly a 3.5% return. And I would say these areas up in here are likely as well. If we go up to 107, we're getting closer to 5%. And a 5% move up in the dollar should see a 10% correction in equities and broad sectors. If we look at that same move in Nike, and then we'd be looking at a pullback to about 100. A breakdown of 10% would bring us right to about 100, which would bring us back down to the beginning of 2023. And just use this as a confirmation. Confirmation to say, yep, consumer discretionary is sliding if I ignore Tesla. And then I don't even care what Tesla does. Tesla could go up, it could go down, it could be a tech play, it could be a gamma squeeze. Tesla can rise on Elon Musk launching a new rocket. It doesn't matter. In the end, if we take Tesla out of the picture and we take Nike as a substitute, we're seeing whether we're seeing demand or not. Reality is the Fed is not concerned, at least on the surface, it appears they are not concerned about whether the economy is getting the liquidity, whether the economy is doing well. They're much more concerned about the liquidity in equities as a representation of wealth. And that's a concern to me. Well, that's going to do it for us today. Join me again next week. For those of you in the currency class, we'll talk a little bit more about that starting today.